Hi, I'm Jimmy. In this video, we're going to walk through some of the best ways to value companies from the information technology sector. So my plan is to create a series of videos where we go through each of these 11 sectors and look at what the best ways to come up with a fair value for the companies within those sectors are. Now, I actually already did a video on how to value financial stocks, so I'll leave a link in the description below to that video if you're curious. But the goal here is for us to research and understand which valuation methods provide the best opportunity. So not only am I going to go through the different valuation methods to use, but also whether or not they've worked in the past based on historical numbers. Okay, so let's jump right in. So the IT sector is full of some of the largest and fastest growing companies out there. There's companies like Apple, Microsoft. They have Adobe in this sector. Salesforce.com is in this sector. I just recently did a video on them in the last video, but I'll come back to that in a second. We've also got a company like Square or HubSpot. Now, the tricky part of coming up with a fair value for companies in the information technology sector, or really any sector, is that these are very broad groupings. So information technology, look at a company like Square. Well, Square is very different than Apple. I could make the case that Square belongs in financial services, or Apple is a computer company. Really not, but essentially, you know what I mean, is that we don't want to just look at the group and say, okay, this is the way we're supposed to value companies from this sector. That's why we're doing it every time. We might need to try different methods to see which ones work the best. Okay, with that being said, let's go through some of the ones that do work. So my first and my favorite one, my personal favorite, is discounted free cash flow. So the general concept with free cash flow or discounted free cash flow is that we come up with estimates for what future free cash flow will be. We then discount that by our required rate of return. And in theory, this tells us what the company should be valued today to earn our required rate of return, assuming that our forecasts, our projected numbers, are correct. Now, the reason free cash flow could make sense is the company could then use free cash flow to perhaps grow the business, or maybe they buy back stock, or maybe they pay off debt, or pay dividends. There's lots of options with discounted free cash, with free cash flow in general for the company. That's one of the reasons this is my favorite way of valuing a company, because free cash flow, it's very elaborate. It's dynamic what the company can do with it. So in theory, if we could pay less than our calculation of fair value for a particular company using discounted free cash flow, well, over the long run, we should do quite well. Now, this is an actual calculation that I had done for Salesforce's stock in a recent video. And these are the numbers that I used for free cash flow projections, and then we discounted it by a required rate of return. And right up to this point, this calculation is correct. But the huge mistake I made, and I feel very foolish for making it, was that I did not use the correct shares outstanding. So if we were to look at the value of the total company, well, the value of the total company is actually correct. That is what it should be. And given that the current value of Salesforce's stock is about $205 billion. Well, it looks like there's some upside based on the company value. But because I divided by the wrong shares outstanding, the per share value is incorrect. The correct numbers would have been about $253 per share. So again, that was a mistake. I apologize for bringing it up. I'm really using this opportunity to apologize for making that mistake. It was a silly mistake. We have to be careful with this type of calculation. Discounted free cash flow is a more elaborate calculation. Again, I did a video on how to do this. I'll leave a link to that video in the description below if you want to do it. But another option to do is, instead of discounting free cash flow, is using something like price to free cash flow. Price to free cash flow could be a good one to use. It's a simplified version while still incorporating the benefits of free cash flow. Using price to free cash flow could make sense. Let's imagine we weren't confident with projecting out free cash flow over the next few years. Well, if that's the case, we can use free cash flow over the past 12 months, compare it to today's price, which is simply the calculation. We take the price per share divided by free cash flow per share, and you end up with a multiple. So I'll show how effective this type of multiple can be when we look at the industry in general. I'll do that in a second. But another option, as far as valuing stocks in this industry, is to use a simple price to earnings multiple. I have found, based on my studies, that price to earnings seems to work well, especially for the larger companies. Now, we could either use price to earnings, standard price to earnings, which is today's price versus divided by earnings per share over the past 12 months, or forward earnings per share. You'll see I have those both labeled as number 3 because they're really the same thing. Forward earnings, instead of using the past 12 months, we use the next 12 months. Again, you got to make some estimates there. So, or we could just use analyst estimates. Could be worth it, especially if the company is, let's say, just getting profitable, or perhaps they just made a big acquisition. So looking out the next 12 months makes more sense. And again, these tend to work for larger companies, or at least more profitable companies. Now let's pretend that the company is not too profitable. It's on the smaller end. It's in the growth phase. Well, using something like EV to EBITDA usually could make a lot of sense. EBITDA is short for EV is short for enterprise value. EBITDA is short for earnings before interest, taxes, depreciation, and amortization. Again, you can get that right from the income statement. And that makes sense with smaller, faster growing companies because oftentimes they might not be profitable yet, but they do have positive EBITDA. So that it could be a simpler valuation method to use. But I think the two to really focus on in our case, based on my studies that have proved to be pretty efficient, is price to earnings and price to free cash flow. And I'd love to show you what discounted free cash flow, how effective it really is, but it's a very difficult thing to backtest. We can go back and look at price to earnings or price to free cash flow, but to go back and look at discounted free cash flow would be a very tricky thing to do. That would be very time consuming. And really, how do you come up with estimates for what they would have been 5 years ago? That'd be very tricky to do. So I'm just sticking with these two for now. Now, this is a longer term chart of an industry ETF. This is the Vanguard Information Technology ETF, ticker symbol VGT. So I use this ETF to represent the entire industry. So we can look at how these valuation methods really work, and we can sort of backtest whether or not they would have actually been effective and how effective would they be compared to if we just ignored them and just bought anything whenever we wanted it. So the theory, what we're trying to accomplish here is that let's imagine we're looking at price to earnings or price to free cash flow. And let's pretend that the multiple that we calculated was 20x. Well, that would mean that the current price is 20 times either the earnings or the free cash flow that the company generated over the last 12 months, depending on which one we're looking at. So if it was, let's say whatever the multiple is, was 20x down here at the financial crisis, back when that happened in 2008, well, let's pretend that as time went on, let's pretend earnings fell the same amount as the price. The two of them fell side by side. Well, if the two fall side by side, you would end up with a price to earnings ratio or price to free cash flow ratio of the same amount. So you might end up with 20x still. Well, then things begin to grow. And as they grow, as earnings per share grows, let's imagine the stock price sticks exactly with it. And it sticks with it all the way to this time period and again to this time period. Well, if that's the case, looking at price to earnings or price to free cash flow, or really any multiple, or wouldn't really help. Now, of course, this generally does not happen because the market can be very irrational and moody and crazy, and generally the market tries to be very forward-looking. So the valuation, the multiples do fluctuate a fair amount. So what we're looking for is, can we pay a lower multiple? Lower is better in both of these cases. We want lower multiples. That, in theory, will lead to higher returns. We'll come to how much higher returns in a second. But for now, let's zoom in to the financial crisis time period so we can get a better idea of where multiples were back then. And then when we add the price to free cash flow and price to earnings for each of these different high and low points, well, we can see that for the information technology sector, price to earnings and price to free cash flow have done a great job of guiding us. If we did our best to buy stocks only when they fell below, let's say, their long-term average for either PE or price to free cash flow, well, if we did that, we would very likely have done well over the long run. We would have bought, in theory, somewhere near the bottom because we would have seen the multiples drop relative to the long-term average. In theory, that presents us with a better opportunity for long-term gains. Now, once again, we can see when we fast forward to today, so from today back the past few years, well, now we have the multiples. Once again, these multiples did a pretty good job of guiding us. If we had bought back down in 2018 when the multiples dropped, well, that would have been a great buy. Would have also been another great buy back in March of 2020 before the coronavirus happened. So compared to the pre-coronavirus levels, that level looks pretty good. Now, if we're curious what the price to earnings and the price to free cash flow ratios look today for the IT industry, well, we can see that the numbers look pretty high right now. Now, this doesn't necessarily mean we have to sell, let's pretend we owned VGT or even any big company within the industry. I'm not suggesting that we have to sell this stock right away. And here's what I mean. Let's imagine that we created our own internal rules. Maybe we say if the sector falls below a price to free cash flow of 20x, well, we'll consider buying it at that point. But if it's above it, we're not going to consider buying it. And let's imagine we could have bought down here at 16x or again down here at 18x. But just sticking with one example for a moment, let's say we're going to buy down here when it hits 16x. We see that, we're very excited about finally seeing this multiple fall. We're willing to jump in and hold for the long run. But now we see the stock starting to run up, and at some point it gets to about 26x. Sure, we could sell. In theory, we could sell if we wanted to and then buy when it hits below 20x again. But do we really know for sure where to sell it? Do we sell when it gets to 22, above 25? Where would it have been? Because if we had just held it, even if we got nervous when it fell back below 20x, well, at some point it came back. We would have made back all of the gains that we would have previously had, plus more. I think setting high limits on when to sell our stock is a tricky thing to do, because then you could potentially miss out on a crazy high valuation or the long-term growth that we're ultimately after. Now, just to illustrate how much of a difference following internal rules could make, let's imagine we had bought this ETF back when it was trading here at 23x. So we decide that we're going to hold it. We're still holding it to today. Well, if we had bought at that point 23x, well, at that point, we're up about 82% today, which is pretty good. I'm happy with that overall return. But if we had waited just, in this case, 7 weeks, and it fell below our, let's say, 20x rule, whatever that is, well, if we had bought it down there, well, at that point, if we held till today, we would be up 138%. That's a 56% difference for ultimately just sticking with internal rules that we've created based on history. Whatever company we were looking at, or if it was this ETF, I would calculate what the long-term average is and where our buy range is, and then wait for it to get there. We might miss out on this entire run, this entire opportunity if it never gets there. But if we do that for all of our investments, we're far more likely to be successful over the long run. Now, if you're curious when to sell a stock, well, I actually did a video where I walked through some of the best ways to determine when we should sell our stock, because that is something that we want to be aware of. So if you're curious, perhaps that could be a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.